Here's a belief that quietly costs retirees a lot of money. The idea that when the paychecks stop, the taxes mostly stop too. It feels like it should be true. You've been paying taxes your whole working life, so surely retirement is the reward, the tax-free finish line. But it isn't, and the people who assume it often get an unpleasant surprise on their first retirement tax return. Today, calmly and with real numbers, I want to show you what a retiree actually pays in taxes, where the surprises hide, and why the problem usually isn't the tax rate at all. It's how your different income sources stack on top of each other. No fear, no doom, just the math laid out clearly, so that when it's your turn, there are no surprises. Let's start with a simple map, because retirement income isn't taxed all one way. Think of your money in buckets. Bucket 1 is your traditional retirement accounts, your traditional IRA, your 401k, and any pension. Every dollar you pull from these is taxed as ordinary income, at your regular rates, because you never pay tax on that money going in. Bucket 2 is Social Security, which is partly taxable, up to 85% of it, depending on your other income, and we'll get to exactly how that works. Bucket 3 is your regular brokerage account, where long-term gains get their own, lower tax rates. Bucket 4 is the Roth, which, if the rules are met, comes out completely tax-free. 4 buckets, 4 different tax treatments. Almost everything that follows comes from understanding which bucket your money is in. Here's the first thing people get wrong. They assume that just because they've retired, they've automatically dropped into some tiny tax bracket. Sometimes that's true, but often it isn't, especially early on. If you have a pension, a healthy 401k you're drawing from, and Social Security, your total income can look surprisingly close to what you earned while working. The tax brackets themselves don't disappear when you retire. They apply to your taxable income the same way they always did. So step 1 is to stop in retirement means low taxes and start actually looking at the numbers for your own situation. Sometimes they're low, sometimes they're not. Point is to know, not to guess. Now let's talk about the piece that surprises people the most, taxes on Social Security. A lot of folks are shocked to learn their Social Security check can be taxed at all. Here's how it works, kept simple. The government looks at what's often called your combined income, which is basically your other income plus half of your Social Security. As that number climbs past certain thresholds, more of your Social Security becomes taxable, first up to 50% of it, then up to 85%. Now, here's the trap. Those income thresholds were set decades ago, and they are not adjusted for inflation. So every year, as incomes and cost of living drift up, more and more ordinary retirees get pulled into having their benefits taxed. It's not a new tax, it's an old one that quietly catches more people every year. This is where it gets interesting, and it's the heart of today's episode. Because of that Social Security rule, a single extra withdrawal from your IRA can do 2 things at once. It gets taxed itself as ordinary income, which you'd expect. But it also raises that combined income number, which can make more of your Social Security taxable at the same time. So $1 extra out of your IRA can effectively be taxed, and also drag some of your Social Security into being taxed alongside it. The result is that your real effective tax rate on that withdrawal can be much higher than the bracket on the chart suggests. Nobody hands you a warning about this. It just shows up quietly in the math. Understanding it is what separates a calm retirement tax plan from a nasty April surprise. Let's add the next piece. For years, your traditional IRA and 401k grew tax-deferred, which felt wonderful. The government was always going to collect eventually, and the way it does that is called a Required Minimum Distribution, or RMD. Starting at age 73 under current rules, you're required to pull a minimum amount out of those accounts every year, whether you need the money or not, and pay ordinary income tax on it. For someone with a large traditional balance, that forced withdrawal can be substantial. It can push a perfectly comfortable retiree up into a higher bracket and, as we just discussed, make more of their Social Security taxable too. That's why some people call it the tax bomb. The bill was always coming. Question is just whether it lands all at once at 73, or whether you smoothed it out ahead of time. Now here's one almost nobody sees coming, and it isn't even on your tax return. It's called IRMAA, which stands for the Income-Related Monthly Adjustment Amount, and it affects your Medicare premiums. Here's the idea. Above certain income levels, Medicare charges you higher premiums for Part B and Part D. Cross one of those income lines, even by a little, and your monthly premiums step up. It behaves exactly like a tax, a surcharge on having a bit too much income, and it has a sting in the tail. It uses your income from 2 years earlier. So the income on your tax return today can quietly raise your Medicare premiums 2 years down the road. A single large withdrawal or a one-time gain can trip it. It's small compared to the headline numbers, but it's real, and it catches people completely off guard. Let's put these pieces together, because individually none of them is scary, but stacked, they create what advisors call the tax torpedo. Picture it. You take an extra withdrawal to help a grandchild or cover a new roof. That withdrawal is taxed as income. It also makes more of your Social Security taxable. It may nudge you into a higher bracket. And 2 years later, it can bump your Medicare premiums through IRMAA. One decision, 4 ripples. This is the real reason retirement taxes surprise people. It was never about one high rate. It's about how the pieces interact, so that an extra dollar of income can cost you far more than the tax table alone would suggest. Good news is that once you can see the torpedo, you can steer around it. So how do you steer around it? The single most powerful tool is having money in that 4th bucket, the Roth. Because qualified Roth withdrawals are completely tax-free, they don't count as income for your brackets, they don't push your Social Security into being taxable, and they don't count toward IRMAA. Think about what that means. A year when you need extra money, pulling it from a Roth instead of a traditional IRA can let you help the grandchild or fix the roof without setting off any of those ripples. A Roth isn't just a tax-free account, it's a control valve. It gives you a way to access money without lighting up the whole tax machine. That flexibility, late in life, is worth an enormous amount, and it's why the Roth deserves a starring role in this conversation. Which brings us to the order you pull money from your buckets, because doing it thoughtfully can genuinely lower your lifetime tax bill. There's a general idea worth understanding. Many retirees benefit from spending their regular taxable brokerage money first, then their traditional tax-deferred accounts, and saving the Roth for last, so it keeps growing tax-free and stays available as that flexible valve. But it's not a rigid rule, because sometimes it makes sense to deliberately pull a little from the traditional account earlier, to use up low tax brackets while you can. The details depend on your specific numbers, and this is a wonderful thing to map out with a tax professional. The takeaway is simply that the order isn't random, it's a lever, and pulling it thoughtfully can save real money over a long retirement. Here's a piece of timing that a lot of people miss, and it's genuinely good news. There's often a window in early retirement, after your paychecks stop. But before Social Security and required withdrawals fully kick in, where your taxable income is unusually low. Those are sometimes called the gap years. And a low-income year is a valuable thing, because it means you may have room in the lower tax brackets that would otherwise go unused. Some retirees use those years to deliberately move money from their traditional IRA into a Roth, paying tax at those low rates now, so that money becomes tax-free later and shrinks the future RMD bomb. You don't have to do anything fancy. But it's worth knowing that those quiet, low-income early years are often the best tax planning opportunity of your whole retirement. Let's not forget that 3rd bucket, your regular brokerage account, because it plays by different and often friendlier rules. When you sell an investment you've held more than a year, the profit is a long-term capital gain, and those are taxed at their own special rates that are lower than ordinary income rates. And here's the part people love. At lower income levels, the long-term capital gains rate can actually be 0. That's not a loophole, it's how the brackets are written. So in a low-income year, some retirees can sell appreciated investments and owe little or no tax on the gain. Like everything else today, the details depend on your total income, but the lesson is that not all income is taxed the same, and knowing which is which lets you be intentional about what you sell and when. Before we get to the scary-sounding stuff, let me give you a piece of genuinely good news, because taxes in retirement aren't all downside. When you turn 65, you get a larger standard deduction than younger taxpayers do. There's the regular standard deduction everyone gets, and then an extra amount stacked on top just for being 65 or older, and more still if you're a married couple where both of you have crossed that line. On top of that, as of 2026, there's an additional deduction aimed specifically at older taxpayers, subject to income limits. What does all this mean in plain English? It means a meaningful slice of your income comes off the top before any tax is calculated at all. For a lot of ordinary retirees, that larger deduction is exactly why their real tax bill ends up lower than they feared. So yes, we're going to talk about traps and torpedoes, but keep this in your back pocket. The tax code actually gives older Americans a bigger head start than it gives everybody else. Verify the exact figures for your year, because they change, but the head start is real. Let's make all of this concrete with a picture. Imagine Margaret and Jim, both 74, a normal, careful retired couple. They have Social Security, a modest pension, and a traditional IRA. Everything felt fine until their RMDs kicked in at 73. Those required withdrawals added a chunk of ordinary income on top of everything else. That extra income made a large share of their Social Security taxable, nudged them into a higher bracket. And 2 years later, it tipped them just over an IRMAA line, so their Medicare premiums rose. None of it was a disaster. Added together, it was thousands of dollars they hadn't planned for, all flowing from one thing: too much of their money sitting in the traditional, fully taxable bucket, with nothing in the Roth to give them flexibility. Same income, very different outcome than it needed to be. Let me put rough numbers on it, just so you can feel the shape of it, and remember, these are illustrative, not a prediction for you. Say their required withdrawal came to around $20,000 that first year. $20,000 was taxed as ordinary income. But it also lifted their combined income enough that another chunk of their Social Security that had been sitting untaxed suddenly became taxable too. So the real cost of that $20,000 withdrawal wasn't just the tax on the $20,000. It was the tax on the withdrawal, plus the tax on the newly taxable Social Security it dragged along with it. Then, 2 years later, because that year's income crossed an IRMAA line, their Medicare premiums stepped up by roughly $100 a month between the two of them. Add it all up in one routine, required withdrawal rippled out into a tax bill that was meaningfully bigger than the bracket alone would have told them. Not a catastrophe. Just a completely avoidable surprise that a little planning could have softened. Now let's rewind and imagine they'd known all this a decade earlier. In their early retirement gap years, when their income was low, they could have moved some money from the traditional IRA into a Roth, a little at a time, paying tax at those low rates. That would have done two things. It would have built up that flexible, tax-free bucket, and it would have shrunk the traditional balance, which means smaller required withdrawals later, a smaller Social Security tax hit, and less IRMAA risk. The point of this isn't that Roth conversions are right for everyone, because they aren't. The point is that the outcome wasn't fixed. A few calm, informed decisions in the quiet years could have smoothed the whole picture. That's what planning actually is, seeing the ripples before you make the splash. Let me add an important word of balance, because it's easy to get so focused on taxes that you make a worse overall decision. Taxes are one piece of the picture, not the whole thing. Never let the goal of saving a little tax push you into a choice that's wrong for your life, your comfort, or your family. A slightly higher tax bill in exchange for peace of mind, or for helping someone you love at the right moment, can be entirely worth it. The idea here isn't to obsess over every dollar of tax. It's simply to understand how the system works, so you're making informed choices instead of blind ones. Calm and informed beats anxious and clever every single time. Keep the taxes in their proper place. Important, but not the boss of your retirement. So how do you turn all of this into something useful? A few calm steps. First, figure out which buckets your money is actually in. How much is traditional and fully taxable? How much is Roth and tax-free? How much is in a regular brokerage account? That balance alone tells you a lot. Second, get a rough picture of your income sources and whether your Social Security is likely to be taxed. Third, pay special attention to those early, low-income gap years, because that's where the opportunity usually lives. And fourth, if you have a large traditional balance, this is exactly the kind of situation where sitting down with a tax professional pays for itself many times over. You don't need to become a tax expert. You just need to know enough to ask the right questions. Step back with me, because there's a lesson here that goes beyond taxes. So much of a calm retirement comes from understanding how the machine works before you pull the levers, instead of discovering the rules after the fact. Retirees who get surprised by taxes usually aren't careless. They just assumed retirement was simpler than it is, and nobody showed them how the pieces fit together. Retirees who stay calm aren't tax geniuses. They simply took the time to see the whole board, the buckets, the thresholds, the ripples. That clarity is available to anyone willing to look, and it turns a scary, mysterious topic into just another set of numbers you can plan around. Let's bring it together. Taxes don't stop in retirement, your brackets still apply. Traditional accounts and pensions are taxed as ordinary income. Social Security is taxable up to 85% depending on your other income, on thresholds that never adjust for inflation. Required withdrawals at 73 can push your income up, and IRMAA can quietly raise your Medicare premiums 2 years later. Stacked together, that's the tax torpedo. Your defenses are a Roth bucket for flexibility, a thoughtful withdrawal order, and using those low-income gap years wisely. And through it all, don't let the tax tail wag the dog. That's what I'd love for you to take away. Retirement isn't tax-free, but it doesn't have to be full of surprises either. The whole thing becomes calm the moment you can see how your income sources stack, and you start making decisions with the ripples in mind instead of against them. Look at your buckets. Notice your gap years, and if the numbers are large, bring them to a professional who can map your specific situation. These figures and rules are current as of 2026, and they do change, so please verify the details at irs.gov or with a tax advisor before you act. This is the Retirement Lab, where we run the numbers so you can retire with fewer surprises. I'm Susan Mitchell. Take care of your numbers, and they'll take care of you.